Shanghai trading with just a minor positive uptick right now, just around 9 points in the green.
For FY24, IMF has forecast India's growth rate at 5.9%.
Well, TCS, according to the consensus expectation, is likely to report a 1.9% dollar revenue growth on a quarter-on-quarter basis.
One could sense some loss of momentum, right? So this needs to be watched.
Buffer Securities is turning bearish, and they've cut the earning estimate between 2 to 13%.
30 points higher on the Nifty. The sensex is up about 80 odd points.
This sideways or consolidation is not just in India, it's global.
The penetration of CNG vehicles in our portfolio should increase.
Own brand sales has seen a sales growth of 15% in Q4.
The Nifty today is above the 17,750 mark.
March data is indicative of a possible recovery.
With changes in technology, battery chemistry, I'm sure it's a matter of time that EVs will succeed.
Achieved a turnover of about 55 crores for GCMMF.
The March CPI is, according to our poll, expected to come in at 5.63%.
We have Nifty, which is sitting at the day's high, 80 points higher on that one right now.
That was the day so far. Hello and welcome to Closing Bell, live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar, with me, Mangalam Malu and Surabhi Upadhyay. Good afternoon. The bulls have decided to camp on the Dalal Strait, and they're not leaving just yet. 17,800 conquered on the Nifty. 8th consecutive day of gains. It's up 0.5% on the benchmark indices. Mid-caps don't want to be left behind. Mid-caps moving in step with the frontliners. The advanced decline ratio firmly in favor of the gaining side. So this has turned out to be another smart session for our markets. The big movers today, pharmaceuticals, autos and IT. IT is seeing buying ahead of numbers starting from TCS today, post-market hours, and Infosys tomorrow. But it's going to be an action-packed evening as well. So quickly, let me lay out what is lined up after the market shut for trade at 3:30. So at 5:30 p.m., we're going to get the India March CPI and the February IIP data. The March CPI expectation for March India is that it's expected to moderate on a quarter-on-quarter basis, 5.6% versus 6.4% month-on-month. IIP is less important, backdated growth number, but the February IIP estimate is of a more than about a 5.2% growth. US CPI inflation will also be out, and that's also expected to show a moderation. 6.4% in January was down to 6% in the month of February, and currently economists are expecting a number of 5.1 to 5.6% for the month of March. And to add to that, you've got an earnings calendar. So TCS press conference is at 5:30 p.m. Numbers come out a little before that. 4:30, 5 p.m. is when we should expect. And the big three numbers that we are watching: dollar revenue growth, 1.9%, constant currency revenue growth, 1%, and EBIT margins of 25%. And the FOMC minutes from the March meeting, the Fed meeting in the month of March, when we had a 25 basis points rate hike, will be out at 11:30 p.m. India time. And that will also give an indication of the conversation between the Fed officials about the banking crisis and the impact. So not just on inflation, etc., but we will get clarity on the direct and indirect impact of the banking pain. So as I said, the gainers are pharma, auto and IT. On the losing side, you've got Nestle a bit subdued, HUL. State Bank of India is putting the entire Nifty PSU banking index under pressure, and SBI has lost close to about 1%.
All right. You said bulls have camped on the Dalal Strait. It's been 7 straight sessions and 8th session running. I was just mapping that journey of the bulls, post the 17,300 mark. I was just looking at it. April has been a month for the bulls, and how. On April 3rd, we conquered 17,400. The next trading session was April 5th, 17,500. April 6th was 17,600. Yesterday, 17,700. And today is 17,800. So that's how we've done. At some point, of course, after this rally that we've seen over the last 7-8 days, we run the risk of running into resistances, and the 100-day moving average really stands out there for both the Nifty as well as the Nifty Bank, just a couple of 100 points away from where we are right now. But in this mountaineering climb, if you have some Sherpas, they're basically the option writers. So every day we've seen option writers take the market higher by the ones who were caught on the wrong side. The 17,700 call writers who believed that the market wouldn't cross past that 17,800 mark, caught on the wrong side. So all of them have unwound their positions. Some 43, 44 lakh shares have been unwound, and as a result of which the market's only moved further higher. And the put writers are the Sherpas at the bottom. We're protecting the support of the market. So 17,800 put writers extremely active right now. 1.3 crore shares added. 50 rupees a premium. That's telling you that 17,750 is an important support to watch out for, and 17,750 put writers too, equally active. So support moved higher from 17,500, 17,600 to now 17,700 to 17,750. The only index to watch out for in the last hour of trade is the mid-cap index, because it's Wednesday, and as it's happened over the last 3-4 Wednesdays, the NSE has introduced a new futures product, which is mid-cap weekly options expiry, and that takes place on Wednesday. The mid-cap index has been outperforming all through this week, so let's see whether that sustains in the last hour or not.
Well, because of everything that you folks said, especially the options levels that you mentioned, Mangalam, for me, this is going to be a very interesting 1 hour, because we've been watching the zone of 17,750 to 17,800 with the Hawkeye past 2-3 days. This is where the congestion is. This is where the resistances come in. And it's not done yet. I mean, there's still a fight going on. We're just 10 points now shy of that 17,800 mark. So let's see if it gets taken out really decisively, then that's a complete out-and-out victory for the Bulls. But I think the Bears want to try and still sort of be in the game. So we don't know. It's a very interesting 55 minutes ahead. But what is definitely working in favor is the fact that this is not a unilateral move led by just the Bank Nifty or one big move on a Reliance. It's pretty wide. As Rima mentioned, there's IT that's come back. There's, of course, a lot of pharma, and we'll talk about that as we go forward. Let's pull up the Nifty contribution list if you can. Quite a few names. In fact, barring large cap consumer, almost every other part of the market is doing really well. Large cap consumer and SBI, those are the only two areas where there's negativity. Otherwise, you have a lot of different pillars and legs to this rally. So far, so good. Advance decline ratio has been holding up pretty well. You still have over 1,800 stocks advancing and just about 1,080 or so declining stocks. So the breadth is good. It's pretty wide and diverse. And the Nifty is definitely taking aim at that 17,800 mark. So we'll wait and watch, but definitely advantage Bulls, at least for the time being.
Absolutely. And here's what's lined up in the next 1 hour on Closing Bell today. A whole host of stocks in focus. Pharma stocks gain as Q4 is expected to see an improvement in margins owing to a decline in input and freight costs, even as key drugs keep exports healthy. Divi's and Biocon lead the pack higher.
AMC is trade higher despite downgrades coming in. We'll talk about some of the trends at play. The stock's up between 1.5% to about 4%.
Auto stocks, Eicher Motors, Hero MotoCorp are in focus on the back of fresh brokerage calls. Key highlights from the reports coming up.
We'll discuss the market and specific sectoral action with Abhiram Elswarupu of BNP Paribas India. All that and more over the next 60 minutes.
All right, and as we speak, a bunch of stocks doing extremely well this afternoon. IFB Industries, not a stock that we talk about often, but it's seen a 15% jump, and this after a large trade that took place. So 0.5% equity of IFB Industries was exchanged. So it'll be important to know the participants of that large trade. Was it some influential investor or an influential fund house? Because as a result of which we've seen a 15% jump there. Sula continues to do well. Greenply Industries is the other one, which is up around 7%. So how should you position yourself in the last hour of trade? Mitesh Thakkar, as always, joins in with his closing strategies. Mitesh, 17,800, do you think that is congestion after a rally that we've seen for the last few days? Or do you think it's just about to break out?
Mangalam, I think the overall setup is good afternoon. But, I've been advising, and since yesterday, around 730, 740 levels, that time to take some profits off the table, especially on the index. The idea is that I believe that this is a significant transition zone. There's a weekly average, there's a previous stop which was made in the March, and then this a gap which happened in February. So I think given all that, and also the fact that, we have had about nearly about 950 kind of a point kind of rally from the lows in the last about 8 sessions, and we are overbought on the hourly charts. There's a stronger possibility that you will see some booking a couple of days of consolidation. In that you'll get some kind of a pullback, and therefore I think booking the index is what fully is now what I recommend. Overall, I think market will possibly maybe get to about 17,650, 620 zones to buy into, which would be excellent levels to build long positions on the index. And I believe that, eventually 18,800 and head towards 18,000 plus level. So stay positive, but I think take some profits, at least on the index. On stock side, we're trading with long buys.
So exit the Nifty now, buying only at levels of 17,620 for an eventual upside target of 18,000, right?
That's right.
Okay. What about the individual stocks? What are you selecting?
Yes. Yeah. So I have, and Nifty Pharma is something which has given a good breakout in the last few days. You've seen excellent movement happening over there. So I picked up Lupin. I think that's a buy. Keep a stop at about levels of 669 and a target of around 700 plus can be looked at over here. And the other one is InfoEdge or Naukri. I think that's one of the IT names which possibly is outperforming compared to the rest of the sector. And the set on the technical side is very positive. So that's a buy with a stop below levels of 38.20. Look for targets of 39.30.
Okay, got that, Mitesh. Thanks for the calls. We'll come back to you in a bit from now. Well, the sector in focus definitely is pharma. Actually, there's a unilateral move across the board. Divi's, of course, is the star performer with almost a 9% gain. Ekta is joining in. Ekta and I were having a pretty longish chat on this on our digital segment, Who Moved the Market just now. Ekta, time for an abridged version. What a day for pharma stocks.
Well, thanks for that. Yes, Divi's Labs is buzzing in today's trading session. In fact, it's seeing a strong move. And that is because the company is really reacting to export data ex-molnupiravir for March, which has shown a recovery, and is a piece of data which is followed very closely in terms of the sell-side analysts in the past couple of months. So it is indicative of the fact that in March 2023, they generated around $92 million in terms of export data versus around $70 million year on year. This is the highest that we've seen since Jan 2021 and is higher than the run rate of around $50 to $60 million that we've seen in the past couple of months. Now, the key point is that there is a bump up, which is likely by higher custom synthesis sales, supplies of an API drug, which is basically to Novartis, which is used for heart failure. And that could have contributed as much as $15 to $17 million in the month of March. Remember that March generally could be one-off data. We could see a push due to year-end sales, so one needs to see whether or not it is sustainable. But despite it being lumpy, it is indicative of the fact that maybe there could be a recovery which is taking place in Divi's sales ex of molnupiravir. Remember, the stock has also fallen quite sharply, over 30% from its 52-week high. At one point in time, it was really a darling of all of the investors, especially during COVID-19. And that possible interest is now coming back. There is also, remember, their margins, which the street will watch quite closely. In Q3, it had fallen quite sharply. So a Q-on-Q recovery and sustainability of the margins is something that the street would watch quite closely.
Okay. All right, Ekta, thanks very much. That's a takeaway on what could be powering Divi's, and that's that really phenomenal move that's playing out right now. Prakash Diwan is joining us to take us through the last hour. Prakash, you guessed it. What else but this one? I mean, the stock is still way off the heydays. I mean, I remember, I think it was 5,000 plus back in 2021. Yeah. But today, there's a lot of excitement around the fact that perhaps their non-molnupiravir business is also looking up. Your thoughts, and whether you'd be a believer and a buyer?
No, absolutely, Surpi. So I think the kind of data that has come through for March is indicative of probably of a structural rebound of sorts that finally is in the making. I mean, we've been waiting for this every quarter. Divi's was looked at very, very keenly for any sort of an indication of a revival. And the US market has been fairly tough for them. So not taking away the fact that it's been tough for the entire large cap pharma pack. But, some time back, we were talking about why pharma has gone through a sea change in terms of mindset and, the ability to be able to comply with the US FDA regulations in such a significant way that you'll probably see a very, very quick comeback of sorts for the larger players, at least to begin with. So, and Divi's is, of course, best in breed in that sense. Don't see any reason why, if the change is structurally long-term and positive, the stock would not kind of take up that 20-25% upside, which it needs to match its highs. But importantly, remember, it's still under-owned, and that's the good part. Even if the structural story is a long-term story, there will be probably, in the immediate short term, you'll probably see a lot of buying that will come into it. So I'm quite positive on that, given this news flow and given the setup that particularly at the moment it exists for Divi's.
All right, Prakash, thanks a lot for that. In fact, just hang in there because we are not done with our daily dose of pharma yet. Ekta, now reasons might be individual, but the stocks are moving in packs. We have Biocon as well, up almost 4% right now as we speak.
Well, yes, for Biocon, there are two brokerage notes which have really aided sentiment today. So I'll start with BOFA, which has a buy, but they've cut the target price to 330 versus 390. According to them, the risk-reward seems favorable at current levels. The concerns of a biosimilar market being like a generics market is also unwarranted. This other note on Biocon is by Bernstein, which has an outperform rating, target price of 299. There are some highlights from a webinar which was held with the Biocon Biologics leadership team. This includes that the Viatris deal is to play the long-term biosimilars market. Integration did not require much rationalization. Management is looking to raise funds, but with the right partner at the right time. Further stake sale in Syngene is not in the mix right now. They are hopeful of launching key drugs such as insulin aspart by FY24. And the management, interestingly, is rethinking and redrawing contours of the tie-up that they have with Serum. So that is something that the street would watch out for as well.
Thank you very much for that, Ekta. Diverse stocks are moving up. So IndusInd Bank was under pressure since morning and it was trading in the red because the latest shareholding pattern as of March seems to suggest that it may not get included in the MSCI Standard Index when it comes up for review because of the FPI headroom falling short of the threshold of 15%. But in the last half an hour, IndusInd Bank has seen buying and now has recovered 1.5% from the day's low to get back into the green line. Oil India is seeing buying up 2.7%, pretty large volumes. ICICI Pru has rallied close to about 1.8%. Indian Hotels, another one. We'll be talking more about the hotel space, but Indian Hotels has zoomed in trade. And lastly, TCS. TCS has gained close to about 1% in trade ahead of numbers. So since we're on the subject of TCS, let me quickly run you through what is the street expecting. Dollar revenue growth, 1.9% quarter-on-quarter. Constant currency revenue growth of 1%, though there is a very wide range of expectations on the constant currency. 0.1 going up to 1.7%, which is where we've arrived at an average of roughly 1%. Margins are likely to expand on a sequential basis by 50 basis points to 25%, aided by lower subcontracting costs, higher utilization, lower wage hikes, just generally better supply side management because attrition too has been on a declining front. What will you track? The outlook on BFSI particularly, because BFSI has been in the eye of the storm. It contributes more than 30% to TCS's revenue. So is it getting impacted? Deals. Is the current macro impacting and denting the deal pipeline in the future? The company has guided for $7 to $9 billion of deal wins every quarter. Is that in any way under, is there a risk to the company not being able to achieve its deal flow guidance? And finally, to keep it short, let me just end with the outlook from the new CEO, the CEO designate, K. Krithivasan. Maybe he's not going to make big statements about, the big picture till he officially takes charge in September. But I think any statements from him, any words, will be closely latched onto. But Prakash, what's the street positioning? Yesterday, the entire sector was in doldrums. Everyone was selling, worried about what the companies are going to guide for and what the outlook is going to be. And today, suddenly, the mood seems to have turned, and IT is coming for some buying ahead of numbers. So there is some optimism going into the results now.
Markets always confound us, don't they? And I think it's very, very clear that the TCS, we are going into TCS numbers with absolutely low expectations. And that's precisely why today the market probably saw that mid-cap IT come back and some sort of an interest coming into that space, which probably made people believe that the large cap companies, and particularly TCS, might not do as bad. Right? So, and I'm sure that could happen. Anything above 1% constant currency, anything better than 25% margins. I mean, those are metrics that could very easily be, surmounted of, and that could mean there's some sort of buying that will be pent up and that will come down to, translating into some stock movement. But, I think it all depends on, as you rightly said, the commentary going forward and how IT is positioned for the whole year. And if that is encouraging, you'll probably see a very, very fierce pullback on most of these large cap IT names.
Right. We will monitor all of that. IT and pharma is what we've discussed, but we're not done with all the discussions. In fact, Prakash, hang in there. On the other side of this short break that we're just taking,
pressure and blame it on the FMCG boys, the consumer stocks basically. The market has lost about 20 points from the topmost levels of the day, 25 points. But in any case, the gain is still about 60 points, so can't take away from that. FMCG is the big spoil sport today, really. Let's move to another sector which is in focus, and that's because of a report that has come in from Bank of America Securities. They have turned bearish on asset managers, and they've cut earnings estimates by 2 to all the way up to 13%. Stocks, however, are holding up in positive territory. Let's bring in Nimesh, first of all, to understand the rationale. Nimesh, so why is BofA turning bearish on AMCs?
Well, Surbhi, the key reason for them to turn bearish is that they believe that because of the regulatory issues, there's going to be a big impact on the margins, and hence they've turned bearish and they've cut the earnings as well between 2 to 13% for most of the AMCs. But the stocks are not reacting, and the simple reason is if you look at all the 4 listed stocks, everybody's down between 20 to 30 or 40% from the respective 52-week highs. So looks like some bit of this concerns are pretty much in the price, so to speak. So that's the reason why you're not seeing big reactions. But having said that, BofA has turned negative on the entire sector, and they've cut the estimates and target prices. Now, specifically on stocks, BofA has downgraded HDFC AMC to neutral from buy. There they've cut the target price to 1950 now. On Birla AMC, they've turned neutral with a target price of 370, and on UTI AMC, they've done underperform, and they've cut the target price of 645. As I said, there are key headwinds for the entire sector, and that's largely coming in from the regulatory proposals. Now, SEBI is looking at some big proposals as far as the AMCs are concerned. That includes in which TER should also include the GST, brokerage, STT as well. In fact, there is a proposal to uniform the TER as well across all the schemes, and also remove the additional expenses. Now, put together, if there is no rebate or if there is no offset, then BofA believes that this can have an impact of 30 basis points and could further impact the earnings for most of the AMCs. So on back of all this, they've sharply cut the target prices, and they've cut the earnings as well across all the listed AMCs, and they've downgraded most of the stocks. But as I said, because the stocks have corrected 30-40% from the highs, the stocks are not reacting today. But there is a clear headwind for the entire sector, and hence a big downgrade for all the listed AMC stocks.
All right, Nimesh, thanks a lot for that. So, a downgrade coming in for all the AMC stocks. Meanwhile, just keep an eye on a couple of these cement names. So, Ultratech from the front line and Shree Cement, all of them have moved towards the lower end of today's trading session. Just a word on the FMCG pack. Nestle's underperformance is a little more than everyone else. That's purely optical because it's also gone ex-dividend to the tune of 75 odd rupees today. So, if you just pull up the Nestle chart, you would see that the stock optically looks like it's down by 277 rupees. Adjust for the dividend, is down just about 202 rupees, 75 rupees. So it's just 200 rupees is what the stock is lower by.
Okay.
But 75 of that is the dividend itself. Just keep an eye on a couple of these other discretionary names, however, which are doing extremely well. Page Industries has moved to the high point of trade, and all things medicine and medicals are doing extremely well right now. Diagnostics, for instance, Laurus Labs up 6.5%. We have Metropolis up 5% as well. Prakash is still with us. Prakash, what are your thoughts on Page Industries? I mean, after a long time, we've seen the stock move well. Everyone speaks about this being a barometer of whether there is a slowdown in the economy or not, etc. But now raw material prices coming down for everyone, and this could be clubbed as an essential. Your thoughts?
Yeah, so I don't know how much to rely on as a barometer of overall growth in the economy. But yeah, what's probably helping them is the rest of the market is not being able to improve any of their market shares. I mean, if you see the peer group, they remain very, very small and very insignificant in that sense. And Page has been able to not only expand its reach, but also the product lines that it has, all of them have started seeing a lot of deepening. So whatever they have put their hands into, whatever was new is now mature enough as a product line. So the contribution is much more balanced, is my view. And that's where the stock starts getting more interesting. It's always been trading at a premium, Mangalam, there's been no doubt. But then the premium justification starts catching up with earnings and with the quality of earnings improving. So I think that's what's happening to Page. But too soon to kind of call it a great buy or something at this point in time. But yeah, it has started looking interesting, irrespective of the state of the economy, as the underwear index would indicate.
Okay. Well, I just want to point out some more stocks that are on the move. Add a Max Health to a list of major movers on the pharma, diagnostics and hospital side. The stocks surged up 5-6% higher. A lot of this has just happened in the last, I think, half an hour or so. That's a big mover that we're talking about. There we go. That's the upswing. Along with that, fertilizers are having a massive, massive rally, whether you're picking up something like a FACT or an NFL, pull up a RCF, you name it, all fertilizer stocks up between 7%, 15, 16, in some cases 20%. That's a massive surge underway. Now, I'm not sure, Prakash, just very quickly on fertilizers, whether this is just a sentimental trading play. Yesterday, the IMD says, don't worry, monsoon won't be so bad. It'll still be, meeting the long period average. Would you read anything additional into it? Any trading interest on the fertilizer side of things at all?
I think, the monsoon definitely reminds people to look at some of these, themes. And it's quite strange that we don't look at them on a continuous basis, but on a very sporadic basis. But what's interestingly different for fertilizers is that, the changes that the government has made and the DBT impact is so well entrenched now, Surbhi, that they really have very lean balance sheets. It's like what happened to sugar a couple of years back. Everything kind of started changing from 2021 onwards, and you see in these 2 years how dramatic the rise has been for productivity and working capital efficiency. The same thing is happening in fertilizers. Probably people have chosen to kind of ignore it because it's got a lot of regulatory complexities around it. But my sense is you will probably start seeing these appear in portfolios in a gradual way, selectively. The likes of Chambal and RCF and all would probably make a start, and then the others would follow. But yeah, it's an interesting pocket. No, not the most rewarding at this point in time, but definitely interesting to look at or to cherry pick out of at some point in time.
Okay, Prakash, thank you very much for talking and explaining, so many sectors and stocks for us. Let's move on and talk about autos. Eicher Motors and Hero MotoCorp is on our radar again. Fresh brokerage calls coming in from Macquarie. Sonia is here with details. Sonia, I think every single day this week we've been talking about autos, and either it's a Goldman upgrade or it's a downgrade from Maruti. Take us through the latest.
Absolutely. There's lots happening in this sector, right? It's also because a lot of things are changing. So just to give you a sense of what Macquarie has put out, they say that the commercial vehicle sector is now moderating, and hence they've gone ahead and downgraded Eicher Motors to a neutral. They've lowered their target price to 3,258. They've also cut their earnings estimates for Eicher Motors, both in FY24 and 25. And they say that the commercial vehicle cycle is now starting to moderate, and they are factoring in lower multiples for the commercial vehicle business. They have a higher discount. They've placed a higher discount compared to larger peers like Ashok Leyland and Tata Motors because of the underperformance. Now on Hero MotoCorp, Macquarie has a cautious note. They maintain a neutral, but they've lowered the target price. They're saying that Hero continues to trade at a 20% discount to its own 10-year average. That's because of the consistent loss of market share in its core motorcycle business. And now you also have Honda coming out with a 100cc bike, which could increase the competitive intensity. And they also speak about how there is limited success in the premium motorcycle segment. They haven't been able to grow their EV business in a big way, as well as now there's competitive intensity, which could put further pressure on their margins. So the headwinds are not over just yet, and hence two cautious notes coming in from Macquarie on Eicher Motors and on Hero MotoCorp. Back to you.
All right, Sonia, thanks a lot for that. We would have loved to speak to Prakash about this as well, but another day, because we always rack his brains on auto way too much. Let's welcome Abhiram Elasurupu, who is the head of India Equity at BNP Paribas, joining us now. Abhiram, 7 days of a rally on the Nifty. We can call it a rally, and 7 days mainly because of the underperformance that we've suffered for months before that. Do you feel any more optimistic? Or is your mood still, indecisive?
Thank you for having me. Yeah, I think we've generally turned a bit more constructive. If you recall, in the previous few times that I was here, I was kind of highlighting the risks to valuations and earnings and so on and so forth. But if you see year to date, India has underperformed most global markets by 10 to 15%, if not more in some cases. And if you stretch that back to, let's say, last September, compared to, say, China, we've underperformed quite significantly. So this period of both price and time correction has lasted quite a bit. And now when you compare this with where bond yields are, for example, the scenario for equities has become slightly better. So if we take a kind of a 12-month view, our Nifty target is 19,250. So that suggests a high single-digit upside from here. Broadly, we've turned a little more positive over the past month or so.
Abhiram, we've been chatting now for so many years on IT particularly, and you've been closely tracking that sector. And your view is that markets are being too bearish about the outlook for IT. And I remember this is what we had spoken about last time as well on air. Can you take us through your thesis going into IT earnings now?
So we're still positive. In fact, very recently, our analysts also put out a report talking about how IT demand tends to track nominal GDP growth. And therefore, during inflationary periods, actually demand for IT holds up quite well. And if you look at what the peers, global peers are saying and the guidance they've given, it does suggest that demand is certainly not collapsing. Now, all that said, IT managements typically tend to be cautious at the start of the year because there are so many unknowns that they have to factor into their outlooks and guidance and so on and so forth. So in the forthcoming earnings season, I wouldn't be surprised if the numbers may be okay, but the outlook for next year, while the commentary may be strong, the numbers given in terms of guidance may be a little bit disappointing. But I would think that will not change the 12-month or 3-year view on the sector, and will probably still remain positive. It also so happens that when demand is somewhat not as good as, say, last year or the year before, large caps tend to have a slightly better positioning compared to the mid and small caps.
You're saying that if the guidance is disappointing, it's on account of the management's being conservative, and therefore the best approach is overlook the management commentary, and if there is a dip, go ahead and buy it? Buy the stocks?
Yeah, I mean, at the end of the day, management speak what they see today, right? But most of the lateral data points or indicators that we have been tracking suggest that demand is not going to fall off as much as investors believe. So yes, I tend to agree with your view. We're still constructive. If there is a significant correction, we'd actually be buyers into that.
Okay, so you're looking to buy IT. Abhiram, hi, good afternoon. You also said that you're beginning to get a little more constructive on the market in the last 1 month. So what else apart from IT would you like?
So for us, financials remain kind of evergreen. We still like financials, especially the large banks. We've been positive on private banks, but of late, we've also started to get a little more constructive, a little lower on the quality curve, if one could call it that. And therefore, the below prime segments are also looking interesting. I mean, all this stems from the fact that risk appetite for companies is starting to increase. Balance sheets are still reasonably strong. The asset quality is still holding up rather well. So we think growth will be still okay. And at the margin, it's likely that the growth will broaden beyond just the largest banks. So I think I'd be kind of looking at a broader spectrum in financials to invest. And furthermore, insurance companies have taken a bit of a beating in the past few months. But of late, we've been kind of looking at the data a bit more in depth, and we start to think that maybe that's a bit overdone. And in fact, across financials, if there is one area we are most positive on today, is actually insurance.
Abhiram, just wanted your thoughts on the pharmaceutical and healthcare space, because I remember you being constructive in the specialty pharma space. At the same time, you said that you hold all your positions in healthcare. That's doing you well. I mean, this month it's been one of the best performing sectors. Have you increased your positions there, or you continue to hold on?
By and large, the view is unchanged because when we do give out these views, they tend to be a little longer term in nature. So it's largely unchanged. We still like specialty pharma and domestic oriented businesses. But where we are incrementally more positive, and I think I briefly highlighted this last time when we spoke, is the diagnostic space. Firstly, we think that competitive intensity is decreasing. And also companies may have a bit more pricing power than the market believes. So over the next few months or so, you may start to see the larger labs start to increase prices just a little bit, at least to hedge themselves against inflation. And that may start to shield their earnings a bit more. Valuations have corrected quite a bit. And I think that space is looking particularly exciting within the overall healthcare space.
Okay. Abhiram, let's just snap out and talk about the market as a whole. I mean, we've been going through this time correction, consolidation, call it what you want, for many months now. Do you anticipate that this is going to be a sign of things to come as well? Do you see some sort of a overall broader market move?
Well, I'm actually struggling to create a 12-month single line move in the index for the rest of the year. Because if you come to think of it, there are two major risks emerging. One is whether central banks have indeed beaten the inflation game, whether they've won the battle or not. Because I think, I mean, if you look at least in global markets outside of India, investors are starting to expect rate cuts by the end of the year. And I wonder whether that will really happen or not. I have a feeling that inflation is a bit more sticky than people think. Rate hikes may have come to an end, maybe one more rate hike by the Fed in May, but after that, that may pause. But I'm not sure there'll be rate cuts that the market is thinking. The second element is, and you can see that with a lot of data, especially around the PMIs and so on globally, growth is indeed starting to fall off. We may avoid a recession or maybe just have a mild recession in the US and Europe. But the question is whether that will start to impact earnings as well. At the start of the year, we did think that it will impact earnings. And we still hold that view. So these two risks have to be taken into account. Valuations today are not expensive, but by no means are they very cheap either. So if I were to kind of think of a one-line summary of what I just said, it's likely that we will have choppy markets the rest of the year, but we may end this year with high single-digit returns on the Nifty.
I think people will take that with both hands, considering we've had a bit of a downer last year as well, and this year, at least the start hasn't been too optimistic. Abhiram, just finally, before we let you go, wanted to get your sense on the big debate on the consumer. Right, there's one narrative that the lower end of consumption is where the hurt is happening, high interest rates, and perhaps more susceptible to any sort of stickiness in inflation, monsoon, so on and so forth. So, what's your call? Discretionary versus staples? Do you like either or both? Neither?
Actually, we are highly selective in consumer staples. In fact, the consumer space as a whole. And I think all the points that you mentioned hold true. In fact, we think this quarter will be rather good for consumer staples companies because they'll probably have the tailwind of price increases as well as some RM cost benefit. But we think that both these tailwinds may start to go away in the next few quarters. And while the monsoon may be normal, there is always the debate around whether that will indeed change the consumption patterns a whole lot. We think not. So overall, consumer staples is not the most exciting space for us at the moment. I think where we're starting to pay a little more attention to is on the consumer durable space, especially some parts of, let's say, air conditioning manufacturers and so on and so forth, where valuations have corrected. Of course, you've had some unseasonal rains at the start of the last month or so. But maybe beyond that, as the summer starts to pick up, maybe sales will start to improve and investors start to pay attention more to the valuations that have corrected and probably earnings cuts stop at that point. And I think that space is looking a little more interesting to me.
Okay, so you're watching for the consumer durable space and waiting for the earnings downgrades to stop up there. Abhiram, thank you very much for joining in. We'll chat with you as the earnings season progresses. By the way, Titan is a stock which has suddenly spiked up. Sharp up move in the last 10 minutes. It's now up close to about 0.3%. Big surge on good volumes. Get into a break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We also get above that 17,800 mark. It dithered a bit in the last 30 minutes, but again, it's climbed back higher after 3 p.m. So it's 17,810, inching towards a 90-point rally on the Nifty. Let's get a handle of what dealing rooms is saying after this 8-day run-up that we've had. Nimesh Shah joins in. Nimesh.
Hi, Rima. So, a strong day for the markets, and the good part is it's backed by the institutional buying. So, the second day running, the feedback is there is strong buying, and I believe there is a basket buying as well at a leading FID. So, that's helping the large cap names in today's trade. But the good part is, outside of large cap names, there is a good amount of momentum in the mid cap and small cap as well, and the broader markets are relatively outperforming. So, that's good because it actually helps the sentiment as well for retail investors. So, that's where the big momentum seems to be. I guess the sector of the day is clearly pharma, without saying big moves on that stock, on the entire basket now. Not only it's fresh buying, but I believe some bit of aggressive short covering as well by some leading FIs. Remember, this is one sector which was usually under-owned and has underperformed as well. So a combination of buying and short covering is helping all the pharma names today, and that's the reason why they are buzzing in trade. On the flip side, there is selling pressure in the IT names. That was the feedback for the last many days, and that's been the trend today as well. Before the TCS number, some bit of softness continues in the IT name. So net, a good day, largely backed by FI buying. And the good part is the momentum is back, and now the broader markets have started outperforming, and that's a good sign from a sentiment point of view.
Oh, yes, it is. 17,811, 8112 and counting. So really the bulls have prevailed just before the earnings season starts off. Nimesh, what about individual stocks? Anything interesting you're hearing?
So in terms of individual names, the first is a pair of two stocks, which is Tata Motors and TVS Motors and Tata Power. Both are not buzzing in trade, but the volumes are on the high side. I believe there is strong amount of buying flows in these two stocks. And as I said, there is a basket buying. So these two stocks are part of that basket buying at a leading FI day. So the volumes are going to be on the high side in both the stocks. So that's the first part. The second one is Chola Investment Finance. In a good market, that stock is under pressure today and on good volumes. I believe a leading long-only fund is an active seller now. Remember, the stock is outperformed within the NBFC and is pretty much at a 50-week high. So some bit of profit booking, so to speak, in that name by leading FI, and hence that stock is under pressure today. The third stock is Max Healthcare. This is going to be interesting. A large block, nearly 1.8 crore shares change hands. I believe it's between FI to FI, but the leading long-only fund was a buyer in today's block deal, so the disclosure will be important. But a very large long-only fund has bought into Max Health today. And remember, there was initiating coverage as well from Motilal Oswal just few days back. So this is one stock to track going forward. And the last stock is IGL. After a few days of consolidation, again some bit of buying interest is back, so the volumes are on high side, and I believe some strong flows as well is helping IGL to rally in today's trade.
Thank you very much for that, Nimesh. That list is very helpful as always. Let's get back, Mitesh Thakkar, to talk about the market technicals. Mitesh, are you tempted to go long now that the Nifty seems to be trying to inch higher, or would you wait it out? And your BTST calls?
No, we've kind of taken profits on the long positions, and the Nifty hasn't slowed down. In fact, it's back to the day's high. So I think that's slightly not to what we had penciled in, but maybe we'll take it tomorrow morning in case we get a gap up, then we'll go long. Otherwise, there's a good chance that there could be some kind of a pullback. Having said that, Laurus Labs, and I think pharma is something which has been on the focus for the last few days. Laurus Labs is a BDST with a stop at 316 for targets of 330, 335. And the other one which I like is again from the healthcare sector, that's Metropolis. That's a BTST as well. Keep a stop at about 12.80 and a target of around 13.15 can be.
Hey, got that. Thanks very much, Mitesh, for the calls as we get set for the last 10-15 odd minutes of trade. Well, before we move on, Mangalam is now going to bring us some very interesting research. I'm looking out for this with a lot of interest because there's a comparison between hotels and hospitals as investment ideas or an investment thesis. Mangalam, take it away.
Well, the word hospitality has the word hospital in it. So I was wondering, why is it that hotels and hospitals can't be looked from the same lens? Mainly because they're all buildings operating rooms and beds on which they earn rent. I wasn't the only one. I think some analysts at Jefferies had the same curiosity, and which is why they came up with a report called Hotels versus Hospitals. Now, intuitively, these are as different as mini bars and medicine boxes, but they do have some similarities as well. Both industries belong to the service sector, have buildings and rooms for which they share similar key operating metrics as well, the likes of average revenue per occupied bed, ARR, occupancy, capex per bedroom, or EBITDA per bed/room as well. And for both businesses, what differentiates them more from their competitors lie in location, the quality of experience, building, rooms, beds, as well as all the other services that they have to offer. But the difference is, of course, we know that no one willingly goes to a hospital, but people do go willingly to hotels. And as a result of which, let's talk about the differences. Hotels, obviously, prosperity for the industry depends on economic buoyancy, as it's a discretionary spend. And at the same time, what differentiates a hotel from a hospital is that there is no dearth of good quality manpower. As far as hospitals are concerned, they are unaffected by short-term economic activities. But what differentiates them and what contributes to the success of a hospital is clinical excellence. And out here, the surgeon pool is very limited. So as a result of which, the manpower is one of the key challenges that they face. I mean, I guess it's easier to train someone to make a bed than to perform brain surgery. Let's move on with regards to the revenue and EBITDA projections for the next few years. Hotels, revenue and EBITDA likely to be higher than hospitals, 10 to 23% on revenues and 14 to 34% on EBITDA. For hospitals, this number is 10 to 14% and 11 to 16%. But while hospitals have a more modest growth, they have higher ROCE because they remain more consistent than hotels, which work in cycles. Why is that? If you just take a look at it, I mean, hospitals have a higher range of return on capital employed. We have 8 to 27% for hospitals, whereas for hotels it's 10 to 11%. The biggest reason for that is that hotels have a daily rate between 12,000 to 15,000, accounting for cyclicality over a longer period of time, whereas hospitals, the average revenue per occupied bed in a metro could go up to 75,000 rupees per day. So while hotels grow faster in up cycles, hospitals are a lot more consistent. And that's perhaps the reason why hospitals, in terms of valuation multiples, also trade at a higher premium than hotels. Hospitals, trade at around 14 to 21 times, and hotels is close to around 12 to 20 times. So what should you invest in? Jefferies says that if you're looking for a short-term pop in the upcycle, hotels are the way to go. Whereas if you're looking for consistent performance, superior ROC over the long term, then you have to look at hospitals itself. Just don't mix your medicines as well as your investments. If you look at the way the stock prices have moved as well, in the last 12 months, hotels have actually outperformed the hospitals. Indian Hotels, Lemon Tree doing extremely well, Apollo Hospitals, Fortis giving you negative returns. But over a longer period of time, the largest hotel company versus the largest hospital company, hospitals have stood out. Apollo Hospitals 300% returns versus Indian Hotels 137% returns. So if you're looking for some top picks right now, Jefferies has 3 as a portfolio bet. Indian Hotels with a target of 380, Medanta with a target of 630, Max Health with a target of 530. Again, like I say, don't mix your investments and your medicines.
Very interesting there. Thank you very much for that. Let's get in Ambrish Balika as well into this discussion. Ambrish, I don't know if you had a chat to listen in to what Mangalam had to say, but one of the bets that Jefferies has is Indian Hotels, and that's a stock that you like very closely. Can you tell us your thesis behind Indian Hotels and where you see it headed?
It's the first name in Indian luxury hotel brand. Taj. I think that's the best brand which is there right now. And it also has other brands like Selections, Vivanta, Ginger, about 30,000 plus keys across 252 properties. And they are adding another 67 properties with about 8,000 keys. That's in the pipeline. But in the next 2 years, expecting about 40 properties out of these to be added. And if you look at the average room rents, in fact, they've seen the lifetime highs. And the best part is that it's sustaining. Because in the past, we have seen those spikes, but it didn't sustain. So if you look at Q3, they've got the highest EBITDA margins till date, which is about 37.6%. And there clearly seems to be a recovery across, whether you talk of business and leisure travel, weddings, MICE. I think the only part which is lagging is the international inbound, which is lagging the pre-COVID numbers. And if you look at the room additions in the industry, that's not really kept pace with the demand. Since the whole of the last decade, like 2010 to about 2020, it was among the worst where the ARRs remained more or less stagnant, except for the intermediate spikes, which I just mentioned. So it is expected that the current ARRs could in fact become the new normal going ahead, which ensures that there's enough free cash flow for further expansion. Though if you look at the new properties, about 70% of the new properties is management contracts against 48% as of date. And in fact, I'm expecting Indian Hotels revenue CAGR to be about 15% over the next 2 years, EBITDA CAGR to be about 20%, expecting an EPS of about 9 for FY25. So my target is about 405 for the stock.
Okay, so that's a big thumbs up on Indian Hotels. Stay on, Ambrish. We'll have some more stocks to discuss, but first a very quick break. Then we come back with some final thoughts on the other side. Strong day for the market, 17,820 as we're getting all set for the close. Ambrish, so let's complete the story. You gave your rationale for that big call on Indian Hotels. Let's talk about the other side as well. Hospitals and healthcare. Definitely as a user, I don't think anybody would want to check in. But as an investor, look at the pharma rally today. It's across the board, whether it's a Max Health or it's a Divi's or it's a Dr. Reddy's. Would you buy anything? Healthcare, pharma, diagnostics?
Yes, in fact, this is what we discussed even last week, that after 18-month lull, we'll clearly see the pharma rally starting off, and that's exactly what has happened. So here my pick would be Dr. Reddy's, Sun Pharma, Alembic Pharma, which hasn't really performed in the last 8 to 9 months. I think these are the stocks where I think we could see decent action.
All right. I think the only line of Hotel California that matches the hospitals is that you can check out, but you cannot leave, obviously, until the doctor says that. Amrish, but you have a lot of other individual picks as well, right? Something that you've brought out for our viewers?
No, in fact, today it was on the Indian hotels, which in fact I had picked. Yeah.
All right. And, I was just looking at IFB Industries. Not sure if you track it. It's a consumer durables company, and there has been a lot of discretionary spend surge that everyone's talking about. They are into some of the cooling products too. Do you, track this, and what are your thoughts on that?
I don't track this very closely, but then I'm quite bullish on the cooling products part of it. So because of which in the past, recent past, I have recommended Voltas, where in fact I have a target of about 50. Clearly, with the way the summer has come in and we'll have that heat wave over the next month and a half, clearly there would be demand for the ACs and refrigerators. I think that's going to shoot up. So it would be Amber and Voltas. These are the two picks which I have.
Demand for ACs, refrigerators, that will shoot up. So will our electricity bills. That's a discussion for another day for the steep tariff hike in Maharashtra, Amrish. But thank you for joining in. Always a pleasure having you on the show. And we look forward to connecting again perhaps next week. Well, as we are winding down the day, this has to go as a day that completely belongs to the bulls, an 8th consecutive day of gain, and not just the 8th day, a day where important resistance levels have been taken out. 17,814 is what the board finally says, and the gainers are across the board. Yes, there's a lot of pharma in it. Divi's up in about 9.5% as we're closing up. Reddy's 2%. There's Cipla, which is on the upside of the screen. But IT came marching right back, 1.5% on Infosys. TCS ahead of its numbers, up about 1%. There's an Apollo Hospitals up about 1.5% as well. Tata Motors, Bajaj Auto, Eicher, they all tell you that the auto pack was revved up again today. And some of the financials, ICICI Bank, HDFC Life, HDFC Bank itself, up about 1.5% as well. So a very well-rounded move coming through. On the large cap screen, at least, the only real disappointment perhaps was FMCG and some of the other consumer names. ITC is down about 0.5%. Nestle, but as Mangalam explained, a lot of that had to do with also the dividend payout that happened today. 1% down on that stock. L&T, Lever, SBI, some of the other large caps. But it's really not a day to talk about too many of the losers, right? Because we've seen serious momentum in the market today.
Serious momentum. 3 stocks ended on the green side for every 2 that were declining today. And the mid-cap index continued to outperform all through this week. In fact, this month itself. And today was the weekly options expiry. So the mid-cap index went home with gains of almost 200 points on the board. And the big gainers, of course, belong to the diagnostic side of things. Laurus Labs, Metropolis Health did extremely well. India Mart also, was among the gainers after a long time. We saw some gains come by for Page Industries. And how can you leave out Pharma? We had Aurobindo and Biocon doing well. Among the losers, we had Chola Investments and ABB India. ABB India actually continued its losses for the second day after a Kotak downgrade came by yesterday.
Well, fertilizer, that's another pocket which saw big gains today. So led by Madras Fert, which was locked in an upper circuit of 20%. NFL rallied in a double-digit gain, while RCF was up close to about 3.5%. So that's another pocket of strength. On the losing side, softness seen in Nykaa. So Nykaa lost close to about 1%. Zomato was down 1%. So some of these new age tech companies came in for some selling pressure. UCO Bank was a tad bit subdued. Delivery ended in the red after Tiger Global sold 1.6% stake in a block deal yesterday. And this was the second tranche of selling by Tiger Global in a span of 2 months. So that was also under pressure. But we finally end a solid session. The Nifty ends above 17,800. Almost at that triple-digit gain, 99.45. That's the number of points that Nifty added on in today's trading session, with the sensex up to 35 points. We're going to wrap in closing bell. Don't go anywhere, because an exclusive conversation with Warren Buffett coming up on the other side.